Imagine a stock that normally trades only 2,000 option contracts a day. Then, without warning, more than 30,000 contracts trade in a single session, and most of that activity is concentrated in one particular call option. Is someone expecting a major announcement? Is a large investor building a position? Or is the activity simply part of a hedge that has nothing to do with predicting the stock's next move? This is the mystery behind unusual options activity. In this video, you'll learn what unusual options activity actually is, what it may reveal, what it cannot tell you, and how to analyze it without falling into the traps that catch many traders. Let's begin with a simple definition. Unusual options activity is options trading activity that is significantly different from what is normally seen in a particular stock or option contract. That difference might appear as a sudden increase in options volume, a large concentration of calls or puts, or an unusually large trade. Volume that is high relative to open interest, repeated transactions in the same contract, a sharp rise in implied volatility, or unusually aggressive trading near the ask or bid price. In simple terms, unusual options activity tells us that something different is happening in the options market. But, and this is important, different does not automatically mean profitable, institutional, or even directional. It is an alert to investigate, not an instruction to trade. Before going further, let's quickly review what an option is. An option is a contract linked to an underlying asset, such as a stock. A call option gives its holder the right, but not the obligation, to buy the underlying stock at a specified strike price before or at expiration. A put option gives its holder the right, but not the obligation, to sell the stock at a specified strike price before or at expiration. One standard equity option contract usually represents 100 shares. This means that even a relatively small number of option contracts can represent exposure to a much larger number of shares. For example, 5,000 contracts may relate to 500,000 underlying shares. This leverage is one reason traders watch the options market. Large positions can sometimes reveal where significant risk is being taken, but they do not reveal the complete motivation behind that risk. This leverage is one reason traders watch the options market. Large positions can sometimes reveal where significant risk is being taken, but they do not reveal the complete motivation behind that risk. There is no single universal number that automatically makes options activity unusual. 10,000 contracts might be enormous for a small company whose options normally trade only a few hundred contracts a day. But for a heavily traded stock or index fund, 10,000 contracts might be completely normal. That is why unusual activity must be measured relative to the normal behavior of the underlying security. That is why unusual activity must be measured relative to the normal behavior of the underlying security. Here are 5 important things to examine. Number 1. Current volume compared with average volume. If a stock usually trades 3,000 contracts per day, but suddenly trades 30,000, its options volume is 10 times higher than normal. That is worth investigating. But high volume alone does not tell you whether those contracts were bought, sold, opened, closed, bullish, or bearish. Number 2. Volume compared with open interest. Open interest is the number of contracts that remained open after the previous trading session. Suppose a particular call option has open interest of 500 contracts, but 8,000 contracts trade today. That tells you today's activity is large relative to the number of positions that were previously open. It may suggest that new positions are being created, but it does not prove it. Open interest is generally updated after the trading day. Number 3. The size and structure of the trades. Was there one large block of 10,000 contracts, or were there dozens of smaller transactions executed rapidly across multiple exchanges? A block may represent a negotiated institutional-sized transaction. A sequence of rapid executions may suggest an order was divided across available liquidity. However, neither automatically proves that an institution is making a directional bet. The trade could be part of a spread, hedge, roll, volatility strategy, or position adjustment. Number 4. Where the contracts traded. An option trading near the ask price can suggest that buyers were more aggressive. An option trading near the bid can suggest that sellers were more aggressive. But this is still an estimate. Every options transaction has both a buyer and a seller. The bid and ask location helps us estimate which participant demanded immediate execution, but it does not reveal every trader's identity or complete strategy. Number 5, the strike price and expiration date. Is the strike price below, near, or far above the current stock price? Does the option expire tomorrow, next week, or 6 months from now? A large trade in an option expiring tomorrow has a very different risk profile from a large trade expiring in 6 months. Near-term, out-of-the-money options may suggest speculation around an immediate catalyst. Longer-dated contracts may reflect a broader investment view, a hedge, or a more complex strategy. Do calls mean bullish and puts mean bearish. This is where many beginners make their first major mistake. They assume heavy call volume is automatically bullish and heavy put volume is automatically bearish. That is not always true. A trader who buys call options may be making a bullish bet, but a trader who sells calls against shares they already own may be generating income and limiting some of their upside. Similarly, a trader buying puts may expect the stock to fall, but a long-term shareholder may buy puts simply to protect an existing position from a short-term decline. So instead of asking only, are they calls or puts, ask, were the contracts probably bought or sold? Were they opened or closed? Could they be part of a multi-leg strategy? And does the activity agree with what is happening in the stock itself? That deeper analysis is what separates useful options research from simply following a call-to-put ratio. Let's walk through a hypothetical example. Suppose a stock is trading at $50. Its options normally trade approximately 2,000 contracts per day. Today, total options volume reaches 18,000 contracts. You then discover that 10,000 of those contracts traded in the $55 call option expiring 1 month from now. The contract traded at an average premium of $1.20. Because one contract normally represents 100 shares, the premium involved would be approximately 10,000 contracts multiplied by $1.20 multiplied by 100. That equals $1.2 million in option premium. You also notice that most transactions occurred near the ask. The contract had only 800 contracts of open interest before today. Implied volatility increased. The stock price was also rising on higher than normal share volume, and the company has an important event approaching. Taken together, these details make the activity more interesting. It appears that traders may be aggressively seeking exposure to a move above $55 before expiration. But we still cannot say with certainty that someone knows the stock will rise. The calls could be part of a spread. Someone could be closing an existing short call position. The trade could hedge exposure somewhere else, or traders could simply be speculating ahead of the known event. The correct conclusion is not, this stock is definitely going to $55. A better conclusion is, this stock is attracting unusually concentrated options activity. The trade structure appears aggressive, and the situation deserves further research. That difference in language is extremely important. When properly analyzed, unusual options activity may help you identify stocks attracting more attention than usual, a sudden increase in demand for options exposure, possible positioning ahead of earnings, regulatory decisions, product announcements, or other catalysts, changes in expectations about future volatility, important strike prices where activity is concentrated, potential hedging or risk management activity, and situations where options traders appear willing to pay unusually high premiums. Notice the word may. Options data gives us evidence of positioning and changing expectations. It does not give us direct access to the trader's private information, intentions, or complete portfolio. Think of it like seeing unusually heavy footprints on a road. You know that something significant may have traveled through the area, but the footprints alone do not tell you exactly who made them, where they are going, or why. Before treating unusual activity as meaningful, check for several common sources of false signals. First, earnings announcements. Options volume and implied volatility often rise naturally before earnings. The activity may be unusual compared with an ordinary day, but normal for the period before a major announcement. Second, position rolling. A trader may close contracts near expiration and open similar contracts at a later expiration date. A scanner could display both sides as large, unusual trades, even though the trader is simply extending an existing position. Third, covered calls and protective puts. Fourth, multi-leg strategies. Fifth, illiquid options. And finally, short-dated options. Contracts close to expiration can attract enormous speculative volume. They can move quickly, but they can also lose most or all of their value very quickly. Whenever you find unusual options activity, use this 5-question framework. Question 1. How unusual is it? Question 2. Where is the activity concentrated? Question 3. How were the contracts traded? Question 4. What is happening around the stock? Check the underlying price, stock volume, news, earnings calendar, known catalysts, implied volatility, and the broader market. Question 5. What would prove the interpretation wrong? Before acting on any apparent signal, identify the evidence that would invalidate your conclusion. This final question is especially valuable because unusual options activity can attract attention while still producing the wrong directional interpretation. So, what is unusual options activity? It is options trading behavior that stands out from a stock's normal pattern because of its volume, size, concentration, premium, implied volatility, or execution characteristics. It can help reveal where attention, expectations, and risk-taking may be changing, but it cannot guarantee the direction or timing of a stock move. The best way to use unusual options activity is as a research filter. It helps you answer the question, which stocks deserve a closer look today? Stock 2, Trend helps organize unusual options volume, call and put activity, premium, momentum, and other market data, so you can identify stocks attracting unusual attention and conduct deeper research. Visit stock2trend.com to explore the latest options activity and discover which stocks may deserve a place on your watch list. And if you found this explanation helpful, subscribe for more educational videos about unusual options activity, options volume, market momentum, and how to interpret the signals hidden inside options data. This content is for educational and informational purposes only. It is not financial advice or a recommendation to buy or sell any security. Options involve significant risk and are not suitable for every investor.